Hey there, and welcome to This Explainer. Look, I'm really glad you tuned in today because we need to sit down and have a super honest conversation about your money. Think of me as your protective older brother for the next 10 minutes or so, all right? We are going to cut straight through the massive crazy hype surrounding initial public offerings, or IPOs. Right now, it's honestly so easy to feel left out. Your friends are probably bragging in WhatsApp groups about their massive listing day gains, coworkers are talking about applying from like 4 different family accounts, and it kind of feels like everyone is getting rich overnight. But when a huge name goes public, it is so incredibly easy to get swept up in that frenzy and just completely ignore the fundamentals. My goal here is to protect your hard-earned capital. We're going to look at exactly what's going on behind the scenes so you can make decisions based on cold, hard facts instead of the fear of missing out. Here is our game plan for today. Number 1, the IPO reality check. Number 2, how IPOs actually work. Number 3, unpacking anchors and GMP. Number 4, your IPO decision framework. Number 5, 4 real Indian IPOs. And finally, number 6, how to apply safely. Okay, let's dive right into part 1, the IPO reality check. So, we have to start by addressing the wild and, frankly, sometimes really painful volatility of recent Indian IPOs. When we actually look back at the market's history, it is shocking to see how easily people get swept up in a narrative. Let's look at the stark contrast between two massive names here. On the left is the ultimate hype trap, Paytm. Think back to their IPO, right? Everyone used the app. The brand was literally everywhere. And because of that, people completely ignored the actual financials. The IPO price was set sky high for a company that was just burning through cash. And the reality hit hard. It crashed 27% on day one. Over the next 2 years, retail investors who held on lost 70% of their money. Brutal. But on the right, we have a genuine wealth creator, DMart. It wasn't some flashy tech startup. It was literally a chain of retail supermarkets. But it had incredible fundamentals and was actually profitable. It soared 102% on day one and has grown 10 times in value since. This stark difference brilliantly illustrates why we absolutely cannot just blindly follow the crowd or trust a big brand name without checking under the hood. Moving right along to part 2, how IPOs actually work. To avoid getting burned like the folks who bought into those hype traps, we first have to understand the basic plumbing of the stock market. Let's clear up the biggest beginner misconception right now. An IPO is part of the primary market. When you participate in an IPO, picture your actual money going straight into the company's treasury. It's directly funding their operations. Maybe they're using your cash to build a brand new factory, or maybe they're paying off a massive bank loan. It is the very first time these specific shares are being sold to the public. Conversely, everything that happens after listing day, when you log into your broker and buy shares on the NSE or BSE, that is the secondary market. In the secondary market, you're just buying secondhand shares from another investor, like me. The company itself doesn't see a single dime of that transaction. So let's walk through the exact timeline of how a company actually goes from private to public. Step 1, the company files this massive hundreds of pages long document called the DRHP. That stands for Draft Red Herring Prospectus. This goes straight to the regulator, SEBI. It lists all their financials, their business model, and critically, their risks. Step 2, SEBI reviews and approves it. But listen closely here, because this is key. SEBI is only checking for transparency and fraud. They are absolutely not telling you if it's a good investment. Step 3, the company and their investment bankers set a price band. Step 4 is the high-tension part for us. A brief 3-day subscription window opens up for retail investors to apply. Step 5, because the good IPOs have way more demand than supply, allotment becomes a literal computerized lottery. You are essentially crossing your fingers, hoping your application gets picked. And finally, step 6, within 7 to 10 days, the bell rings, the shares are listed on the exchange, and trading officially begins. Now, during that highly stressful 3-day window, who actually gets the shares? The total pool is divided into strict quotas. 50% is reserved for qualified institutional buyers. These are the massive mutual funds, insurance companies, foreign investors. They get the biggest slice because they bring in the massive capital required to make the IPO a success. 15% goes to non-institutional investors, which usually means high net worth individuals applying for large chunks. And that leaves exactly 35% for the everyday retail investor, which basically means anyone applying for under 2 lakh rupees. That is exactly where you and I fit into this picture. We're essentially fighting over that specific 35% slice of the pie. All right, part 3, unpacking anchors and GMT. We need to unpack some of the jargon and navigate the murky waters of market manipulation here, starting with anchor investors. So, one day before the IPO opens to the retail public, the company quietly allocates a big chunk of shares to large institutions like mutual funds at a fixed price. Why do they do this? Well, it acts as a massive psychological green light. When everyday retail investors see big, credible names buying in, they immediately think, hey, the water's safe. It builds tremendous confidence. But as your honest older brother, I gotta warn you about the trap here. These anchor investors are locked in for 30 days. They literally cannot sell. They play by entirely different rules, with totally different risk management strategies than you do. So just because they bought in, doesn't mean you're gonna get a profitable exit on listing day. Then there's the biggest hype machine of all, the gray market premium, or GMP. I guarantee you will see this everywhere on social media. This is the unofficial, completely illegal pre-listing market price. People look at the GMP to try and guess if the stock will list at a profit, but here's how it's manipulated. Operators with deep pockets will execute extremely low-volume trades in secret, specifically to artificially pump up the GMP. They create this massive buzz, tricking retail investors into thinking a 30% listing gain is mathematically guaranteed. So, the absolutely crucial point here is never base your hard-earned money on GMP. It is an incredibly dangerous illusion. Remember Paytm from earlier? Yeah, it actually had a positive GMP right before it crashed heavily on listing day. Please, do not fall for it.
Which brings us to part 4, your IPO decision framework.
So, should you actually apply to IPOs? Seriously, think about that for a second. With all the lotteries, the manipulated GMPs, the hype machine, are they really the golden ticket everyone says they are?
Well, here is the harsh reality. I'm going to read this SEBI data directly to you. Most retail investors lose money in IPOs. About 50% of IPOs are trading below their issue price 1 year later. When we actually look at the real data from SEBI, it is pretty shocking to discover that a literal coin flip gives you better odds. Why does this happen? Because an IPO is fundamentally an exit strategy or a fundraising event for the existing owners. The founders and their investment bankers get to choose the exact timing of the IPO to get the highest possible valuation. They are selling when the market is red hot and their specific sector is peaking, which means you, the retail buyer, are usually paying absolute top dollar at maximum optimism. But listen, it's not all doom and gloom. There are absolutely some gems out there, but to find them, you need a robust, unemotional BS detector. Before you ever hit that apply button, you must open that DRHP document and check these 5 things. First, what is the exact purpose of the funds? If they're building a new factory to expand, awesome. If they're just cashing out the founders and paying off bad debt, beware. Second, how much is the promoter actually selling? Are they keeping some skin in the game? Third, look for a real, solid 3-year profit growth track record. Actual numbers, not just rosy projections of a profitable future. Fourth, check their valuation. Compare their price-to-earnings ratio against peers who are already trading in the market. Are they asking for way too much? And finally, check the quality of those anchor investors. Are they reputable mutual funds with a history of long-term holding? Okay, so if that checklist was your green light, these are your absolute non-negotiable red flags. Walk away immediately if the company shows 3 years of continuous losses. Do not buy into the promise of future profitability if they haven't proven it yet. If the promoters are completely exiting and selling 100% of their shares, they are quite literally abandoning ship. Why on earth would you buy a ticket on it? If you see a stretched, completely unjustifiable valuation compared to peers already trading, or if they have a vaguely worded, unspecified use of funds, close your app, walk away, do not apply, period. Let's move to part 5, 4 real Indian IPOs.
Let's spend a minute applying this exact framework to some names every single one of us knows. Look at Paytm at the top there. They had 0 profits and asked for an arrogant, highly stretched valuation. Retail investors bought the brand, totally ignored the red flags, and suffered massive ongoing losses. Now jump down to DMart. They came to the market with a rock-solid, profitable foundation and offered shares at a completely fair valuation. The result? A 10x return for those who held on. It is literally the gold standard of a good IPO. Then you have highly volatile stories like Zomato. They listed at 76 rupees, boomed on the initial hype, and then absolutely crashed when the global tech market cooled down. But because the company eventually changed its fundamentals and actually started showing paths to real profitability, the stock recovered for long-term holders. And finally, look at LIC. It was the biggest IPO in Indian history.
Everyone thought it was a guaranteed winner purely because of its massive size and government backing. But big size doesn't mean big returns for retail investors. It listed at a discount and frustrated investors for years. The ultimate lesson here, a profitable, fairly priced foundation beats sheer size, brand recognition, or market hype every single time. And finally, part 6, how to apply safely. So let's say you've done your unemotional analysis, you've checked the decision framework, you completely ignored the gray market premium, and you found a genuinely good company. How do you actually apply without messing it up? The modern process uses a brilliant system called ASBA, which stands for Application Supported by Blocked Amount. Step 1, select the IPO in your broker app. Step 2, check the retail lot size. It's mathematically capped around 15,000 rupees for one standard lot. Step 3, enter your UPI ID. Step 4, a mandate will pop up on your phone's UPI app, just hit approve. And Step 5, wait 5 to 7 days for the allotment lottery. The absolute best part about this ASBA system is that your money never actually leaves your bank account. It's only blocked. While you're waiting for the lottery, your 15,000 rupees is still sitting in your bank, still earning interest. It is not actually debited unless you win the lottery and get the shares allocated to your DMart account. If you don't get them, the funds are simply unblocked. Let's quickly summarize what we've learned today, because I promise to help protect your capital. IPOs are the primary market where you are directly funding the company's treasury. As a retail investor, you're fighting for a strictly capped 35% slice of the pie. You must remember that the gray market premium is an illegal, highly manipulated, and extremely dangerous illusion designed purely to create hype. Never forget the CB data. Most IPOs actually lose money for retail investors over the course of a year, mostly because you're buying at peak valuations timed perfectly by the founders. Ultimately, calm, cold analysis beats the fear of missing out every single time. I'll leave you with this final, provocative thought. Next time you log into your broker app and you're staring at that shiny new issue and you move your finger to press that apply button, ask yourself, are you buying real, fundamental ownership in a business you truly believe in? Or are you just buying the hype? Ponder that. It's actually the perfect setup for our next explainer, where we'll dive deep into the fundamental philosophy of what stock ownership actually means. Thank you so much for learning with me today. Stay focused, protect your capital, and I'll see you next time.